All right, everybody. Welcome. Today we are going to talk about house hacking, what it is, a lot of stuff about it, how it can benefit you guys, and ultimately how it can help build your wealth and create some of that legacy wealth that you desire for your family. Because really that's the goal of Red Sign Team, is to create legacy wealth and help you guys grow and progress in that aspect of your life. So today, in today's discussion, we're going to talk a little bit about how we can create a successful financial future. Okay. First of all, why real estate will create a successful financial future, how that looks, and what opportunities are represented through that to your family, to kids, everything. We're going to talk about what renting a home versus buying looks like. Okay. So what it would look like numbers wise when you rent a home versus when you buy it, and how we can actually make that more affordable for you. Okay. Then we're going to look at basic methods to living cheaper. Like I just said, how we can make it more affordable and how to continue that growth and leverage it for more success. And then programs that are available to help you start. So the government offers a lot of programs. There's also a lot of local programs for Utah or whatever state you're in. But we're going to dive a little bit into that today. So let's get started. First of all, I want to start with a quote by the KCM Crew. KCM Crew is an economic group. They study basic economics, real estate market, all of that stuff. They said, one of the best ways to build your family's financial future is through home ownership. Recent data from the Federal Reserve indicates that the net worth of a homeowner is actually 40 times greater than that of a renter. So 40 times greater, that's actually a pretty big number. That's nothing to sneeze at. That's a significant amount when you take into consideration these numbers that we're about to look over. Okay. So average rent right now in Utah is about $14.75 a month. Okay. And these are just numbers pulled from the internet, kind of database of what the average is in every city. And that comes out to about $17,700 per year that you're paying for housing. Okay. And your total gain over those 5 years, or the next 5 years, if you're paying that much, is about $88,000 out of your pocket, gone forever. That's never coming back to you. That's gone. That's going to your landlord. And I know most of us would love to make $80,000 in a year, right? And that's not counting inflation. Rents go up over time. So that number is obviously going to be bigger, but based off of right now, the numbers that you have, that is what you would end up paying. Buying. If you have a 30-year fixed mortgage, which most mortgages are fixed right now, with a 5% down payment and a 4% interest rate, right now we're slightly over that. It's kind of bouncing all over the place. But at a 4% interest rate, $500,000 property, your monthly payment would be about $2,200 a month. Okay. Which comes out to about $2,700 per year. Okay. And total gain over 5 years would be about $40,000. Okay. That doesn't sound like a lot. That includes what you're paying in your principal and your interest. So you got to remember that for the first 5 years, a lot of your mortgage goes into interest, right? And that $40,000 is the total gain you see on a very average market at 4% appreciation per year with your mortgage payments that you're making. So over the 5 years, you'd be making $40,000 in your own pocket at 4% appreciation. Luckily in Utah, we'll dive into this in a minute, we've seen a lot more appreciation than that. Okay. So we looked at the numbers and it looks a lot more expensive to rent or to buy than it does to rent. It's almost $1,000 more, right? If you take just a very average scenario. Okay. So we're going to talk about what house hacking is and why that makes it more affordable for you. Okay. So if your house hacking is essentially the idea of living in a house and then renting out part of it. So you buy a house to live in it, but you also rent out part of it to make it more affordable for you. So if you're married, you could do anything like a duplex, triplex, or even just a home with a basement apartment. Okay. And you can rent out whichever one would give you the most amount of rent, ideally, right? And you make that mortgage go down significantly. I mean, in most scenarios, you can cut your mortgage in half in that case. So in this example, you'd probably be paying about, from your 2,200, you'd maybe be able to get about down to $1,200 a month to $1,100 a month for your mortgage that you're paying, which would be really nice, especially if you're paying $2,200. If you're single, you can buy any house, any single family house, and just rent out the bedrooms per room. Okay. If your area works for that, it works a lot in college towns, especially here in Utah Valley. It's very common, extremely common case where somebody will buy a house and then just rent out the rooms. Right now, individual rooms typically rent for $550 to $650 range. Okay. Sometimes you get more if it's a master bedroom or if it has its own private bed, bathroom, whatever. But average, that's about what you can expect. You rent each room in your house for $550 to $650, which in most cases would allow you to pay little to nothing for your mortgage. Sometimes you can even play it out to live for free, and maybe even make a little bit of money on your own home. Okay. So I pulled a random house from the MLS that had a basement apartment, and that home sold for $630,000. Okay. This was just a random house pulled off the MLS with a 5% down payment. That would make your loan amount a $598,000 loan. Okay. You had a 4% interest rate fixed and $1,600 yearly property taxes. Your mortgage would be $3,233. And your overall cost with rental income, you could basically rent that house out for about $1,300 to $1,800, depending on how you went about it, whether you were single or whether you were married, renting out which portion. So your mortgage would be anywhere from $1,900 to $1,400 a month. Okay. We see that that's not much different than the average rent. Okay. And the money goes into your pocket, not into your landlord's. That's the big difference. Okay. We want to emphasize that point because you are collecting the money from renters, and all of the money you're paying is going back into your pocket, back into your equity, into your home. That is a growing asset for you. Okay. Especially right now in the market with the amount of appreciation and money that people are just making off of their house. It's kind of crazy. And the nice thing is that your rent or your mortgage will stay the same. Rents go up. So it may not seem profitable right now, but in 3, 4, 5 years, maybe even just 2 years with how things are going, your rent will go up over that time. And that mortgage payment that you're making will get significantly smaller, which is a huge benefit in your situation. We're going to talk about why this is such a good idea. What are the pros of property investment? So first of all, it's passive income, right? You live in that house for a few years, you move out, rent out the other portion or whatever you want to do with it. And that creates passive income for you. Rents have inflated, your mortgage hasn't, and you can refinance, make your mortgage less and make more money off of it. So creates that passive income. There's also a lot of growth potential in real estate. Real estate provides probably the biggest amount of growth potential than any other investment you can find. And by that, I mean, I don't mean you can suddenly buy into Bitcoin and make thousands and thousands of dollars. I mean, steady, continuous growth over time will occur if you are investing in real estate. Like I said earlier, the average appreciation is 4% per year. Right now, people have leveraged what's going on in the market and have more than tripled those numbers. We've seen almost 30% appreciation in Utah over the last 2 years per year. So people have made over $100,000 just on their house in 1 year. And then that allows you to use those investments and roll them into other investments. So you just create this domino effect. And we'll dive a little bit into that later as well. It's also very stable. I know some people may not think that, but over time, real estate has proven to be a very stable and consistent investment. It has its moments where it goes down, but over time, it is always going to be going up. Regardless of what's going on, it is always going to be going up. Over the last 50 years, we've seen 4% appreciation per year over the last 50 years. And even right now, as crazy as things have been, we've been climbing out of a crash for the last several years, and we're still right at that 4% appreciation average, considering the last few years of where we've been below that. So it's very stable. It's constantly going up, and we can relatively predict where it's going to go. right? They're raising interest rates right now. We can predict that it's probably going to slow down a little bit, right? There's a lot of demand, so there's still going to be people buying regardless of raising interest rates, but it is probably going to slow down. You'll see a lot of those first-time home buyers, or maybe people that aren't very qualified to buy a home, just won't be able to anymore, right? Or they'll have to lower their price point. Either way, but we can predict relatively well where it's going. We also saw this housing shortage in 2020, and we could predict about what was going to happen coming after that, right? We saw how much housing was needed and how much we had, and we could predict that things were going to be pretty crazy for a little while. We're still predicting that. And it increases in value. It's always going up, right? And we'll dive into exact numbers of how much it's been going up recently. And we're going to talk a little bit about real estate versus any traditional investment. By a traditional investment, I mean trust funds or stocks or anything like that, just very stable, what is considered to be your very safe and traditional investment for retirement. Traditional investments are a dollar for dollar investment. What that means is when you put in $1, you get $1's worth of that investment. Okay, so you don't get the total asset amount, you get whatever you're putting into it, and then you appreciate off of that. So, and then there's no tax benefits. There's no tax benefits when you sell, when you trade, whatever, you always are getting taxed on capital gains. Okay, that is just something that it goes on regularly in those kinds of investments. There's no tax break in any of that. Real estate, however, has lots of tax benefits, and for a lot of reasons. The government does not want to own real estate. They want people to own the real estate. So they create those incentives. You get $1 for value investment. What that means is when you put your 25% down payment as an investor, or even just a 5% down payment as a normal homeowner, you're not appreciating off of that 5%. You're appreciating off of the $500,000, the $550,000, the $600,000 that your home is worth. And that's why we saw a lot of people put a 5% down payment and still make $100,000 just off of their own home. That's not even the investment side of it. You know, when people put down a 25% down payment or 20% down payment for an investment property, they saw so much money in appreciation over the last few years that it was just, it was mind blowing. It allowed them to leverage that property and put it into other ones without getting taxed on it. So you can file for a 1031 exchange, defer your taxes, and then just continue that investment growing. Okay. There's no taxes on it if you do it right. And there's a lot of ways that you can play this to your advantage. And it creates legacy wealth. When you've grown all this, you can give it off to your children, to your family, leave that as your legacy. You can really continue this for future growth. Okay. So I'm going to talk about this method that is a proven way that several investors have used to just continuously over time work this and make lots and lots of money. So you build your portfolio and your retirement by creating passive income, and you do that through the BUR method. Okay, the BUR method is, first of all, you buy a house, you buy one that needs some work, so you rehab it. Okay, you buy it, rehab, add some value to it, make it look nicer, then you rent it out. Your rents are higher than what it should be for when you bought it because you fixed it up, you made it nicer. So you're then getting more for your rents. You refinance that after a few years, and your mortgage will go down, and you can use that money to leverage it into another investment. Your mortgage goes down, your rent goes up, and it just creates that gap bigger and bigger over time. Okay. And then you just repeat that process over and over and over again. And that is essentially the very dumbed down version of how you can continue that for future growth. Like I said, it creates this domino effect. When you give an asset time to appreciate, what that does is it creates this massive gap in equity that you can pull from. Like I said, people just made $100,000 on only the value of their house. That wasn't even what they paid off. That was just in the value alone up from appreciation. What that allowed them to do is pull from the equity using a home equity line of credit or a cash out refinance. Okay. What each of those are is basically the bank will say, okay, we'll allow you to pull about 80 or up to 80% of your equity and use that for something else. Whether some people do that to buy a truck or whatever, that's not a very wise decision. Do it for another property to grow your investment portfolio. When you've made that much money in your investments, in your appreciation, use that equity, roll it into something else, and put it into a new investment. And what that does is when you've grown it from one, you put it into another, you then have two assets that you're appreciating on, which allows you to put both of those eventually into two more. And then you've got four, and it just keeps getting bigger and bigger and bigger, right? And then you're appreciating off four, you can put those into four more, which gives you eight, and you just keep doubling it over time. And that's why, I call it this domino effect, where it just keeps getting bigger and bigger and bigger. And that allows you to grow at a fairly alarming rate, especially as of recently. Here's a real life example of somebody we have here at Keller Williams. He's given me permission to use him as kind of an example of how investing really works and what it can do. So Shoni Ivins is our team leader at Keller Williams. He has accumulated 9 properties over since 2016, which would give him, if he were to stop right now, not counting appreciation or rental increases or anything, if he was to just stop right now how it was and retire off of that, it would give him about $120,000 in cash flow per year. Okay. Which would also equal nearly $3 million in total net worth for his retirement. And that is a solid retirement. That's more of a retirement than almost 80% of the US. Okay, that's a significant amount of money for retirement, which proves to be a very stable and solid way of creating that legacy wealth. Because then in several years, when he wants to hand this off to his family, he can, and his family's got a very good head start in creating even more wealth and building a greater legacy for their kids. So what is the cost of waiting? Everybody wants to wait for this market crash that's going to happen, and they want to just get it at the right price at the right time, right? What is that actually costing people? I've known people over this last several years that have said they just want to wait. I'll show you in the last year alone, since January 2021 to January 2022, we have seen a 28.9% appreciation. Okay. That is not a sudden spike either, and I'll show you why. On a $400,000 home, that was $115,000 in equity in 1 year. That was what they made just on the equity appreciation in 1 year. And right now, home prices are worth well over that. You can see right here on this market piece, it says that the average price for the median price was $530,000. That is up 28.9% from last June. So from last January. It was a little bit above 400,000 last January. That's a little bit above where it was, because if you add that, that's about where we're at. So that is just putting into perspective how much money people have missed out on because they wanted to wait for this market crash, this market correction. And it's not just a sudden spike. In September 2021, we saw, prior to the year before that, it was up 27% since then. And in October 2021, it was up 22% from the last October in 2020. It's been going for the last 2 years, and it's just going to keep growing. Utah is a very, very progressive market right now, and economy as well. We've got a lot of growth coming into our state, and a lot of things developing. This isn't going to slow down anytime soon. Even with rising interest rates, we may see it slow down a little bit and just push out people who aren't really qualified. But the reality of it is we've got an economy that is growing at a rapid rate, and things are just going to keep going up. So where should we get started? First of all, talk to an agent. Talk to an agent who's good for you. You can talk to me or somebody else on the Red Sign team and figure out what is the ideal path for you, right? Is it even realistic to look at a house right now? If so, what's the best approach for you? Can we make this affordable for you? Okay. And then you want to also get pre-approved. If you have troubles with credit or anything like that, maybe that's a common concern. People think, oh, well, I'm not in a position because my credit sucks. Talk to a lender. They give you great advice. Remember when I first talked to a lender, my credit was at 640. And he told me what to do. Within a month, I was at 740. Okay. Talk to a lender, get some good financial advice of what you can do to help yourself progress in that direction, and then move forward, creating kind of an attack plan for that. And take some action. Most people will always say they want to do something, or they want to invest, or they want to do this, and very few will actually do it. Robert Kiyosaki himself said, real estate investing, even on a very small scale, remains a tried and true means of building an individual's cash flow and wealth. Robert Kiyosaki is a multi-millionaire, very wealthy guy that has proven that real estate investing over time is just a very, very solid way to build some wealth and cash flow, like he said. So I also told you we would dive into a few programs that are available to you guys. First-time homebuyer programs are everywhere. One of them, you being utahdownpayment.org. That's specifically for Utah, obviously. And then just Google search as many other opportunities as you can. There's tons of them available. Also, the two that were recommended by a lender is Utah Housing Program and the Freddie Mac Home Possible. Okay, those two programs are very solid, that have helped a few people. They're a little difficult to get, but it doesn't hurt to try applying for them and get some assistance in getting your first home. Okay, so check out those programs. If you guys have any other questions, feel free to reach out to me on social media or my number. You can also email me, but this is my contact info on my Instagram. You'll see constant market updates, constant info about what's going on, listings that we've got, everything. So feel free to check me out there, and thank you guys.